How does a central bank actually influence a whole economy? Its most important lever is the interest rate. By setting a key rate, a central bank can nudge the entire economy, making this its primary tool. Understanding it explains much of what central banks do. A central bank sets a key policy interest rate, essentially the rate at the foundation of the financial system, which influences the cost of borrowing money throughout the economy. Because so many other rates are linked to it, when the central bank moves this rate, rates on loans, mortgages, and savings across the economy tend to move too. It is a single lever with wide reach. The logic of using it follows from how interest rates affect behavior. When a central bank raises its rate, borrowing becomes more expensive and saving more attractive, so people and businesses tend to borrow and spend less. This cools demand and helps bring down inflation, but also slows the economy. When it lowers the rate, borrowing becomes cheaper, encouraging spending and investment, which stimulates the economy, but can add to inflation. So the central bank adjusts this rate to steer between goals. Facing high inflation, it may raise rates to cool things down. Facing a weak economy, it may cut rates to encourage activity. For example, to fight rising inflation, a central bank raises its key rate, borrowing costs climb across the economy, spending cools, and price rises begin to ease, all from one policy decision. Central bank mandates, tools, and targets vary from one country to another, and they change with economic conditions. Even economists disagree about how policy and money creation really work, so check which institution sets the rules where you live. The main lesson is simple. A central bank's main tool is setting a key interest rate that influences rates throughout the economy, raising it to slow borrowing and spending, or lowering it to encourage them, to steer inflation and growth.